session 6 of day 2 Entrepreneurship Development Program. We'll start our session soon within 5 minutes. Thank you. Good afternoon, everyone. Welcome back to the EDP program. Now we'll be having the sixth session. We have here with us Anadeep Chappa, CEO of Executive Director of TAE Hyderabad. So sorry for the delay in starting the session. It's my pleasure to introduce you, sir. Andeep Chappa is passionate about entrepreneurship and startups, especially building strategies and processes. He is the executive director of TIE Andhra Pradesh and has been associated with building the organization since its inception. He is responsible for execution of activities of TIE across Andhra Pradesh with the mission of fostering entrepreneurship and building a vibrant startup ecosystem. Prior to TIE, he has been an entrepreneur with ventures in human capital management space. He has worked as an advisor for some of the mergers and acquisition startups. Anadeep has an MBA from IIM Lucknow and BTech in Information Communication Technology from DAIICT. Thank you, sir, for being with us here, and I welcome you from on behalf of all the participants. Dear participants, please be on mute when the speaker is speaking. If you have any doubts, we'll have a Q&A session at the end of the session for 20 minutes. Please post your questions so that sir will be clearing you. And I request Andeep sir to take over the session. Thank you, sir.
Yeah. Thank you, Chandra. Just a second. Let me try sharing my screen. Apologies for the delay. Suddenly my system seems to be acting up. So just give me a minute. I'll join back.
Sure, sir. Hi everyone. Seems sir is having some issue with the system. He'll be joining in a while.
Hello.
Yes, sir.
Yeah. Okay. Sure. Apologies for the delay. Murphy's law seems to be, activated, and suddenly things did not work out even after the repeated trials. So, good afternoon, everyone. And until some time ago, I never realized I need to take a session immediately after lunch, and I know how tough it is. I remember during my school days how tough uh, it was staying awake after class, after lunch, and then how tough it was for the teacher to, engage the students. But I guess we have an interesting topic here. So hopefully you would enjoy the session. Frankly, the topic is vast, and you can speak on and on about it, or it can be quickly closed in half an hour. Everything depends on you all. I would want you all to come up with your queries and be interactive, so that we would be able to uh, make it more engaging. So. So excited to uh, talk with so many professors, people from teaching fraternity and entrepreneurs. Last time I did this was maybe about 8-9 years ago, when I was presenting my BTech project, and now I see so many professors here. So on to the session. Let me start with a brief about myself. So Channa has already uh, introduced me. So I'm currently the executive director of TAI Andhra Pradesh. TAI is a global organization, a non-profit working towards supporting entrepreneurs across the globe. It was started 30 years ago in Silicon Valley, when people from, so in fact the full form of TAI is the Indus entrepreneurs. So when you are in a foreign land, people tend to identify some commonality between them, and then interact. So that's how people from the Indus region there used to connect over the weekends, spend some time, and later on used to spend the time in discussing about problems that they're facing in their professional life and all those. So then some of them felt it's a uh, uh, why not set up a platform that can help entrepreneurs. So that's how TAI is born. It started in Silicon Valley. Now it is present across 18 countries with about 65 plus chapters. Activities of TAI can be classified into the 5 pillars of education, mentoring, networking, incubation, and funding. So it has a network of charter members. Charter members are those who, accomplished entrepreneurs or senior professionals, VCs. It could include chartered accountants, lawyers. So those who've been with the startup ecosystem and then want to give back to the society and helping the next generation entrepreneurs. Um, this TAI Andhra Pradesh was started in 2018 post bifurcation. So TAI Hyderabad has been there for about 22 years now, but post the state bifurcation, people wanted to start a TAI chapter in Andhra Pradesh and support entrepreneurship here. So we started it in 2018, and worked with the government bodies and other ecosystem players and universities, and we started doing a lot of activities related to entrepreneurship, be it knowledge sessions, or we have a TAI university program where we work with universities in university children, business plan competition, and a pitch fest for the university students. So, and then we have a TAI women program, and then TYE for school children. So we have a wide variety of programs that we've been doing to support entrepreneurship in the state. So prior to TAI, I've been an entrepreneur. Fortunately for me, I've experienced all the jargon that you will be hearing in the last hearing in these 5 days. So a bootstrap one. We co-founders came together for a different project, and then liked the idea and we could connect well. So we worked on a recruitment related problem, and then bootstrapped it, built the team. Then as a service, it was initially a service. Then we had to pivot, make it a product-based one, and then we had revenues. Later on, there wasn't the growth that we expected. Then had a different setup, been through the fundraising cycle. So I've experienced, almost every thing that you'll be hearing in this 5 days of the program. So I have an MBA from IIM Lucknow and a BTech degree from Dhirubhai Ambani Institute. And post my MBA is when I started up as an entrepreneur, and then you already heard my journey. So let me directly go into the session. So I just want to understand what, in your opinion, is funding in a startup life cycle. So as soon as you hear the word funding, what are those words that come to your mind? Maybe if you can just take 2 minutes and post your responses in the chat, that would help me structure the session well. So you can just you need not give me the detailed definition or anything. Just give those keywords that you must have heard related to funding, or when we talk about funding, what are those terms that come to your mind? Anything about how important a funding cycle is in a startup's life cycle, or when you hear about funding, what are those words that are associated with it? So anything that you already know. Okay, I see a response. Lifeline of an organization, providing resources. So anyone else? Capital, okay. Blood, investors, money. Sure, the responses seem to be slow, but I hope. Yeah. So the responses seem to be slow, but I hope the interest isn't this way. Yeah,
it's very pleasure to see you. I'm Dr. Nageswara from Vignan University, sir.
Yeah, hello.
Regarding funding, as of my knowledge goes, just by having hope and confidence on somebody's idea, which is related to any sort of solution to the societal or any particular case, the people who can bear that amount of money, they come forward to fund that and support the people.
Great, sure. Thank you, nice Garu. Yeah. So I see some responses in the chat to financial resources, sponsors, investors. So everything is all about money, but there is more than what you actually think about funding. So I'll showcase this in an analogy here. This picture should depict what actually is funding. The first picture shows what an entrepreneur does, or a startup is. It is a seed which has the potential to grow, and you always have the soil and sun, which are like the ecosystem. So depending on the place you are, the kind of ecosystem you are in, such type of seeds can grow. So if you are in a place in like Vizag, where you have a lot of PSUs, or you have a long coastline, you can think of some ideas around that space. So ecosystem also defines what kind of ideas would flourish in that particular region. Of course, now we've grown to be being more global. So being at any place, you can actually execute any idea, but there would be some kind of an advantage by the location and all. So this soil and sunlight, sun are like the ecosystem. So what an investor does is like the watering. So an investor will come on board and help the seed to germinate and grow, and the watering has to be in the right amounts. It shouldn't be too low, it shouldn't be too high, and then the combination would come up to be growing as a sapling, then a plant and a tree. So this can be in short defined as funding. So it isn't just about the money, it has more than that. So once we go in, you would get to understand the complete picture. So let me take you through what an investor looks for when they're investing in a startup. Maybe some of these you must have seen in your sessions in the morning, because there you might have discussed about the fit. So I'll just quickly go through this. Idea, is it really a necessity? Because there will be a number of ideas. Some would be necessary for the world, and some might be a luxury. And so it has to be something which is necessary, because only then you can compel people to actually use your service or product. Because if it is completely a luxury, you cannot claim the complete market, right? So the investor first evaluate what is the idea all about, and is it a good to have or a must have? Because both the kind of ideas do raise funds, but again there are other factors which come into picture in deciding the worthiness. So is the problem being tackled at the surface, or deeper to find the root cause? And what is the problem exactly that is being addressed, and are there any other solutions being addressed already, and where is that gap, and how is this idea unique and compelling, and how is this going to generate more users and all? So then they look for landscape in terms of what's the market size going to be, and who are the target customers, how are you going to attract the customers, and how is it going to change the life of the customer? Without you, how are they, and with you, how are they going to be? And how large is the market going to be, and how much can you grab with your idea, and what is the exact value proposition? And then the team, again, this isn't any, all these are not in any particular order, so everyone has their own way of analysis, but these are the common factors that any investor would look for. Team, can the team execute? Is there a right fit among the team, and will the team be able to deliver what they are envisioning? And then the competition, who are the existing players in this space, who are you going to compete with? And at times there need not be exactly the same model, or same someone who is working in the same space being a competitor. Like say for example, you must have all heard of Kodak. So Kodak did not feel that cell phones are their competitors, so they never really focused on competing. But suddenly cell phones have had these cameras and all, they suddenly wiped off Kodak from the market. So you never know, so you need to be vigilant, and need to have that 360-degree view of the competitive landscape. And then the business model and traction. So what's the business model all about? How are they making revenues? Where are they spending the money? So how is it getting balanced, and what is the value creation? And then the traction. How are they going to build customers? How are they going to the market and getting more customers to use the product? So how are they able to reach the customers? So all these factors would define an investor's view about a startup. Should they invest or should they not? So looking at this, I think are these the factors that are covered in your previous sessions, or are there any that I've missed? So yeah, there is a question. Can you explain the term traction? Traction is the number of customers you have. How are you able to reach, and how many customers are you able to attract to use your services? So if you look at the investor's lens here, it is similar to your idea evaluation or growth market fit. So in a way, the investor and the entrepreneur think in the same way and have a common goal. So investor is like a co-founder who is coming in with the resource of money. So you as an entrepreneur are investing your time, which also has an opportunity cost, and you have the idea. And investor is coming with his strength of money and other aspects that the investor is bringing in. So once an investor comes on board, you are like co-founders working together to a common goal. So there might be animosity before someone comes on board, but post that you'll have to work together. It's like a marriage between two people, and you'll have to stay together. So why and when should you raise funding? Usually any startup goes through the phases of ideation, then minimum viable product or a POC, and then the revenue stage and the growth stage. So usually we've been in the recent times we've been seeing many entrepreneurs at the ideation phase looking for funding, but that's not the right time to look for funding, because none would be really interested in actually investing at the idea stage, because in fact many entrepreneurs don't want to even discuss about their idea because it might get copied. But ideation is not really a differentiation factor. So your idea, if not today, in a day or two, people can easily understand, and immediately after you launch, in a day or two, they can immediately understand and launch it. It isn't a tough thing. Everything is all about how do you put the resources and execution together in building that idea. So that is where your strength is. So ideation is not the right time to actually raise funds, because by then you won't know your complete potential, and the investor wouldn't be able to understand if you will be able to execute things. So MVP and POC stage, here, so maybe I'll cover the kind of fundings or different kind of rounds that go in. That's when I'll go deeper in when you should raise more. But why should you raise funding? So it shouldn't be some kind of business transaction where you build something and you want to sell part of it to make money. So funding is not about making money for the entrepreneur. Funding is all about getting the resource that is key and required for the company to actually grow on to the next stage. So if you as an entrepreneur, or you being like one or two co-founders, so you being a founding team have say 10 lakhs with you. So first look at how do you utilize this 10 lakhs and build something out of it. And then maybe when you are left with the last 3 lakhs or so, you by then have some kind of a progress that you have made. That's when you can showcase it to people and raise more funds, so that you can build the remaining part of the product and take it to the market, or then grow it. So that should be the mindset of an entrepreneur in terms of raising funding. You shouldn't be raising just because it is available, or just because everyone else is raising. If you must have heard of Zerodha. Zerodha never raised money, but they are unicorn today because they were able to bootstrap and build the company. So the cases when you should raise money is when you need that working capital to run your company, or you need that extra money to expand to new markets, new businesses, or if you need to unlock value which you are unable to do currently, and if you want a partner to come in to unlock that value. So because when it comes to investment, it need not be just cash. It can be a strategic investor who can give you that resources where you can be a strategic partner to grow. So someone might not give you money, but they can give you something in kind, or they can give you business. Say you have this, just for an example, you have a newspaper. So newspaper might not be investing money in you, but they can say that I can give you the advertising inventory for you. So they'll give you say 2 lakhs worth of inventory and want to take 2 lakhs worth of equity from you, and you can leverage how you want this. So an investor need not just get you money. It can be in kind too, or it can be a strategic partner who might feel that both of you together can actually build more value. And then investor comes with a lot of support, because most of the investors have been entrepreneurs who built companies and have exited. So they bring in a lot of experience with them to which would help in guiding the entrepreneurs. And then they come in with lot of network. They invest in number of companies, and they look at number of companies where they can invest. So they do have that network who can help you connect with that network and get you a lot of business, or it could be a partnership. So these are the factors that need to be considered when and why you want to raise investment. So now, how much should you raise? As I gave you in that analogy, too much of water or too less of water will kill that seed. So you need to be clear how much you need. So there isn't any yardstick in terms of should I raise 2 crores, should I raise 100 crores. So it has to be based on the purpose and the cash flow requirement that you have. So you need to have a milestone in terms of I'll achieve so much by in a year, beyond which I'll have my revenues which can be plowed back in to grow. So I need some money to sustain until this 12 months. So you need to have a milestone, and then look at the runway. Do you have the money to actually go there, or how much money do you need exactly to reach that milestone? Why should you raise more? It might always look good to have a cushion and buffer, but that shouldn't be too much when if you need 2 crores to actually reach your milestone, you shouldn't actually raise 10 crores so that you can have a buffer. So 2 crores can be maybe at max 3 or 4 crores. It should be more than that. And then valuation. Do you have the right valuation? Because say if everything is going good, your valuation might be different. Then say during COVID, your business might be affected. You might be low on revenues. Then you might be desperate to raise funds to sustain. So then you might have to sell at a lower valuation. So all these factors play a role. So that might not be the right time to raise money, but or right valuation to raise money. But if you still need money, raise money, but raise it only until you come out of that situation and can raise more money at a better valuation. So you need to have these things in mind before you raise money. So are there any queries until now? Okay, then so keep posting your queries on the chat so that I'll have a look at them and then address them when possible. Um, so far we have covered on when should you raise money, why should you raise money, and how much. So now this is all about the different types of sources that you can raise money from. So in the initial stages, easiest option is bootstrapping. Bootstrapping is like co-founder investing their money from their savings and they being the sole owners. So you as if you have have money which can help you build the idea, build the product, it's always good to invest your own money because you will have the complete ownership on the company, so and you can drive it how you want. But say the money you have isn't sufficient, you will have to go for external source and raise money. So these are some of the sources where you can raise money: friends and family, angel funding, and then VC funding, incubators and accelerators. These days, incubators and accelerators also have some funds in terms of where they can invest or as a grant. So they can be a source, and then debt funding. So you can raise take some loans from any financial body or private equity. And crowdfunding is emerging these days, but not yet so active in India. But through social media channels, you can showcase your idea, and you can say that you can book. It's like a pre-launch offers that you see these days. So you can book a product now at a lower cost, and the money that is pulled in can be used to build the products, manufacture them, and sell it. And then business grants. So I'll go deeper into these in the next slides. Maybe crowdfunding isn't much that can be covered later, so that's why I gave a detail about it. So it would allow businesses to pool small investments from number of people. So it can be about pre-launch, or it can be that people can, you can directly say that this is the idea, and I need. You can raise money and give equity in lieu of it, and amounts could be too smaller in size. So what is the difference between debt and equity? Debt is the loans that you see usually from the banks or mortgage companies or any financial institutions. So there you will maintain your complete autonomy. You won't have any ownership dilution. There is no valuation that you need to talk about, or you need not get your company valued at any point of time. And then one factor is you'll have to repay it within a particular time. So if you take a loan for 3 years or 5 years, you'll have to pay back the principal amount and interest within that time. So it's kind of a time bomb ticking, but at least you know how much you'll have to pay, and you know the interest beforehand, so you can always plan it. So there isn't enough. There is not much risk there, and then it is usually the cheapest money that you can raise compared to other sources, unless someone is giving you charity or your family trusting in you and giving money. But usually when you raise money for interest, that's the cheapest. And it is simpler because it doesn't have any other clauses that you need to discuss about. It's just that you need to decide on what is the interest going to be, and when do you have to pay back, and you can raise that money. So usually it has to be used to fund large expenses. And then if you, as I told you previously, a company affected by COVID and just want to survive this 2-3 months so that situation will be back. So for those 2-3 months, you can raise debt instead of raising equity. So the investor's perspective here is they would prefer just the payment back. They just need that interest, and there is no upside for an investor. So it is decided beforehand how much as an investor I am going to get. But it is potentially secured, because when I am investing, I look at, can you pay me back or not, and all those factors. I'll evaluate the startup, if the startup would be able to pay me back, and then only I'm going to give them the money. So it is potentially secured. But when it comes to equity, you will have to give ownership to the investor. So if the person is coming in as an equity shareholder, you will have to decide on the valuation, what's the share price going to be. And once decided, you would accordingly give them the number of shares and take that money. And later on, you don't have to pay it back. So ultimately, if they need money, again, they will sell their shares and make money, but you don't have that obligation to pay back that money. When I say no payback required, it doesn't mean you can do whatever you want with that money. It's like you've given them the share. They're still the shareholders, so they will catch hold of you if you are bringing down the share value by not building the company in a proper way. But you don't have the obligation to pay back the money. If the company fails, or if the company goes bankrupt, they lose money. Of course, you too will lose, because it's your company too. Here, there would be investor involvement, because since they are also now the shareholders, so they would be involved in how are you running the company. They would offer their experience and guidance, and they want to be involved in the decision making process. May not be too much into the executive decision making. They would be involved at the board level in deciding the course of action, how you are going to implement things, and the major decisions they will be involved. So this is a representation of startup funding cycles. Usually, how things work. Of course, this timing may not always be apt, and not exactly in the current market, because it doesn't work this way, where you can raise money only after breaking even, because there are companies who haven't broken even just like we've seen with Zomato. They're still a loss-making company, but they've gone to IPO. So forget about the red line for the time being. And of course, but yes, they are still making revenue. So revenue part you can look at it, but don't look at the break-even point. So initially, when you don't make revenue, you are still trying to build that idea and want to showcase that the idea has a potential, you will have to raise money through angels. When we say FFF, it is friends, family, and fools. So usually friends and family at least know you and invest money, but someone who is trusting you without anything being shown, and so they are referred as fools, and that can be a lucky bet or that can be a good bet. So don't take it in the wrong sense. But and then seed capital. So you raise this money initially to build a proper MVP and a POC. Then you start scaling it, start getting the first customer, and build the traction. Slowly, you raise the next rounds of funding. These are the early stage rounds. So these usually you refer to them as Series A, Series B. So, and then later stages, you might have already identified the right business model, the right approach and execution. It's all about just going to different businesses and making more money. So you execute it in one part of the country, you can expand it the same way in other states or other countries, and then expand and grab as much market as you can. So those are the later stages. So there you raise mezzanine funds, are like the bridge rounds where you need some money to sustain until you go to the next stage. So you raise that money just for those 5-6 months, so that once you raise the next stage of money, you pay back. Say if you are just going to an IPO, so before the right valuation is achieved or the market is in right condition, you want to ensure that you go to the market for IPO at the right time. So you might raise that mezzanine fund to bridge that gap in time, and then once you raise money, you can pay back. And then IPO is like being listed on your stock market, and then you have too many shareholders. Then the initial shareholders that come in through different rounds of funding, and then now it's open for public. Anyone can buy shares. So even anyone who picks one share from the market, they'll be also a shareholder. So once you go into the public market, the shares are traded in the market, and then their exchange of money outside the company's purview keeps happening. So in a market, I can sell share and you can buy it, and the company doesn't gain or lose anything out of it. It's just that based on the transactions, the share price keeps changing, and accordingly the value of the company. So venture debt, this is similar to the loans that you see, but when you go to a bank, loans are usually given based on some mortgage or collateral. So when it comes to venture debt, that is those loans specifically created to support startups, usually they are given to startups backed by investors and been generating revenues. So based on the ability to generate cash flow, they need not generate profit, but if they are able to generate cash flow, then some institutions would be willing to give in money, because it's just about rotating that cash flow. So these people will just put in money now, and once the cash flow is generated and the money is being rotated, again they take back their money and some interest. And then there is this concept of factoring. Factoring is something like selling your liquid assets, or getting an advance based on your liquid assets. Say you have a crore of rupees in orders, and you've delivered all those, but there is a payment cycle. So maybe you get that payment in 2 months' time or 3 months' time. So in those 3 months, but you have a cash flow crunch, and to survive, so for these 3 months at least. So what you would do is you would sell this particular payout that you already have, say for 80 lakhs, because depending on the need and raising money, you sell it at a discount. So you sell it at 80 lakhs. So you immediately get that 80 lakhs. And once that 1 crore of payment comes in, you will have to give that 1 crore to the investor. So this is factoring. So these are the kind of models that you have as venture debt. So now in the previous slide, we've seen there are different stages of funding that would happen. So I've in the current market, the demarcation is slightly blurred, so you don't really be able to identify that demarcation in terms of who is a seed investor, who is an angel investor, because if you look at Sequoia has always been investing in Series A, Series B stages, and these days they've started an initiative called Surge, where they invest in seed stage. or Kalari has K-Start. So everyone is coming up with different models so that they can cover the wider spectrum of investment. So it is slightly blurred in terms of this division, but some factors remain constant. Say pre-seed or pre-seed is something like the initial stages of business. So you did it's something at this stage of uh, here you see this valley of death, right? So it is something similar to that stage where you just have an idea. You don't have a product. You don't have customers. Nothing. You just have an idea and you want to implement it. So you raise this money to do your R&D and identify that market validation. It's just about ensuring that the idea would work. So is there enough market, or why not go into the market and do some primary research or interviews so that you can get some insights in terms of will people buy, or is your hypothesis about the idea working, how can you validate that hypothesis. So you raise this money only for that particular aspect. So usually you'll be able to raise this money from friends and family, grants, and maybe accelerators and incubators. So this is the ideally, though first investment may not be the first external investment or in terms of equity or debt. It's just as a grant usually. And the next stage of early stage or angel funding, you call seed stage. You can also call it as seed stage. So that's where this angel funding and early stage there is an overlap. But angel funding is like a continuation to the previous pre-seed funding. So now you go to someone you might know, may not be a direct connect, or some HNI in your vicinity, in your city, who you can go to and talk to them, and then showcase the validation that you've already done and try to convince them on the idea. So this is ideally the first funding that you raise externally in lieu of equity, or it can be debt. So this should help you build that first minimum viable product and maybe get the first customer. You might get the first customer, but this should help you build that MVP and a POC. So here, you might be able to raise a couple of lakhs or less than about 10 lakhs at times. And then depending on the idea and depending on the number of people that you can reach out to, because maybe each HNI would be able to invest 5 to 10 lakhs maximum, because the ticket size might be even lower. So that is where, in fact, we have these angel networks who would pool all these angels together and put in money. So, you in fact, the previous slide and this slide, you need to look at it together. So early stage funding, here, this is in the context of a VC coming in. These are usually called seed rounds or pre-series A rounds. In fact, these days, Series A has also come into this pool because the amount of money being raised at every round has increased. So previously, if you see, before the advent of SaaS companies or technology companies, the amount of money being raised in Series A used to be like less than $5 million. But these days, in seed pre-series A itself, there are many companies who are raising more than $10 million. So this is slightly blurred, but you can decide on the stage of the company. So here you would have maybe the minimum viable product and POC, and usual investors would be the angel networks and venture capitals, like some of the VCs are India partners, and you have K-Start initiative by Kalari and Surge by Sequoia, etc. Then you have seed funds like Advantage, 100 IC, who would put in money up to 25 lakhs. And the companies like K-Start, Surge, or India, they might invest up till 2 million. So, and then you have angel networks like AngelList, Venture Catalyst, Let's Venture. So these are the platforms which would pull in the money from angels and invest in startups. So here too, you would be able to raise up to 1 crore of rupees. So venture capitals are like they have a rigorous analysis process. They look at a lot of other factors. So they come in with a 7 or 8 year timeline. So they look for higher returns. So come in early, come with vast industry knowledge and network. In fact, they take up the onus of raising the next round of funding for you. So they will do the job of grooming you and making you ready for the next round of funding. So then maybe the growth stage funding, kind of late stage fundings too. So here we have, you can say, Series A and above. So Series A to C is where VCs would be investing, and then beyond Series C, you have VCs and private equity players coming in. So private equity funds, they invest and acquire ownership in private companies at a high growth stage, and usually in companies operational for 10 years 10 years. And these days the cycle has come down, but by then they would know that the startup would succeed and is a dominant player in the industry. So they would then invest for a quick growth and expansion so that they can go to IPO quickly and unlock the value and make more money. So by this stage you would have already had the product market fit and decent scale. So you need this to further scale to more regions or more markets. And some of the names you might have already heard are like Tiger Global, SoftBank. So in this stage, in the recent times, we've been seeing investments of $200 million also happening in these unicorns. So anything above 1 million, so Series A's these days are around 5 to 10 million happening, and then beyond that, you can imagine, and you must be seeing a lot of news on funding. So, but these are the late stage investments. So, before I move to the next topic, are there any queries until now? Okay. So these are some of the.
Sir, I have a query.
Yeah.
So there is a particular situation like initially the startups do away with their equity in exchange for the investment. Is it a good way to do away with your equity?
See, you cannot look at doing away with equity in silos. So say today your company, you know that you need to raise money because you will unlock value and the valuation of the company would grow. That's the first thing, because when external capital is coming, you are actually able to do more than what you are currently, and that's how you are unlocking the value. So today your 100% stake might be valued at 1 crore, and tomorrow 1 crore, and you are taking say 10 lakhs. So you are giving them essentially 10% of the equity. But overall, now with this 10 lakhs of money, you are able to do much more, so that your valuation of the company might go to 2 crores or 10 crores. So then your 90% is actually 1.8 crores. when your company is valued at 2 crores. So previously you are holding 100% but valued at a crore, and now you are holding 90%, which is valued at 1.8. So your value is increasing. So you shouldn't look at it as 100% equity and a 90% equity separately. It's the value that you need to look at. So you are actually unlocking the value. And so because if someone is coming in and adding value, so until now, why should you have 100%? Because it's your idea. You've been doing something for it. You were given your time. You are building it. Someone is coming and contributing their resources, so they need to be compensated for the resources that they are bringing in. So you need to evaluate what is the right compensation, and both of you should agree upon it, and then you can give the equity. The only thing is you shouldn't be giving or diluting too much, so less than the valuation that you are worth of. Because if you are giving in equity at a value, that means you are setting a valuation for yourself. So your next round will be impacted based on this valuation too. So those factors you need to take care. But at some point of time, if you are raising money, you will have to give some equity.
So I have two follow-up queries. Like one is evaluation is a subjective matter. What a valuation in your eyes, something might be different from the other guy, other investor. Second thing is the when I am doing away with my equity, what could be the different chunks? Should I do away with it in 5% increments, or what is the standard that is used in the industry to do with your equities?
So what was your first question?
Like valuation is something it is a subjective matter. It is different for different people.
Yes. So that is where most when people say that they were in discussions for. In fact, usually when an investment happens, it takes almost 4 to 6 months time to get that money in your account. So these 4 to 6 months time is when both of you would work on what is the right valuation. You have a number in your mind. They have a number in their mind. They have their assumptions, because there isn't any proper numbers, right? You wouldn't have raised. You wouldn't have made some revenue by then. So how do you value yourself? So there are different factors and different assumptions that come into picture, and then there will be these discussions, deliberations. So at times it might sound like you going to a shop and want to buy a product, and you bargain based on your thought process, what you think is the right value for that product. So it might, in layman's terms, this might also sound to be same. It's just that for every assumption that you make and every calculation that you have, you need to have have some data backing it, so that you can say that my assumption is more probable, and is closer to reality. So how much you are able to convince the other person and how much they are able to convince you would decide on what is the right valuation. And when it comes to dilution, there isn't any proper cycle, or to say, I need to raise money, and this is how much I'll dilute only 5% or dilute on. So usually, as I've told you, when you decide on how much to raise money, you need to understand how much money you need and what's the valuation that you are at. So depending on that is how you decide on how much is to be diluted. So you know that you need 10 lakhs. So that is constant. So 10 lakhs, if you know that you cannot bring it down, so because your need is 10 lakhs. So that is constant. So whether you are being valued at a crore or 50 lakhs, that depends on how you are able to convince the investor that you these are the factors that would uh, impact your valuation. These are the right assumptions. And if you are able to convince the investor and ensure that he also arrives at the same figure, because some factors would be on, you would think of it as a your market size to be different, and you might say that I'll be able to sell 100 crore products or 100 crore units, and the investor might say, investor has different calculation. He might think, even though the market is worth so many units, you might not be able to manufacture so many and sell them. So you might be able to, he might think that you would be able to sell only 50 crore products. So that confidence that you can give it to him, her, saying that, how you are planning to achieve that particular milestone. Again, I told you, when you raise funding, these are the factors that would impact milestone, the money you need, and the valuation. So if you can give a proper roadmap in terms of how you will achieve that milestone, and how your track record has been so far, then you would be able to convince the investor for the valuation that you want, and automatically you know how much you want to raise, and if you are able to convince them for a valuation, so you know how much is being diluted. And Mr. Ramesh has asked a question, isn't mortgaging a dilution of ownership? Mortgaging is not a dilution of ownership. It's like putting in something that you own in a locker, and then you pay back the money you owe them and get back your share. So that isn't a dilution as such. So they don't get the ownership unless you are unable to pay them the money, and ask them to take this whatever security you've given, ask them to own it. Until that point of time, you are still the owner. So these are some of the key terms that will come into picture during a fundraise. So you must have all heard of term sheet. Term sheet is the initial draft of terms that you agree upon, the valuation, how much you want to raise, so that decides the dilution, and other terms that the investor wants, and you are willing to give them. Then the shareholder agreement. Shareholder agreement is when once the shareholder agreement gets signed is when you will get the money. So this is a legal document. So term sheet is still not a legal document. Term sheet is just an agreement that you are having, agreement on the clauses, but shareholder agreement is the legal binding agreement. So once shareholder agreement is done, they become shareholders, they will give you money, and then it has to be adhered to, and until a new shareholder agreement comes in to replace. So shareholder agreement, once it is in place, would decide what are the rights you have, what are the rights the investor has, and other details. So valuation we discussed just now, and then multiples and metrics. So this is similar to this is to explain the milestones that you've been planning. So when you have to justify your valuation, you need to showcase these are the metrics that you achieved. And multiples is a comparison with the existing companies in the market. You might not see the exact comparable, but you can give a close comparison and say, this company is valued at this stage and their sales are this much, my sales is so much. So you can proportionately calculate your valuation. So that's how multiples will help. And dilution, the amount of share that you will be giving to them. And then the other one major aspect would be the board seat and voting rights. So once an investor is coming on board, so they would want a board seat and voting rights, because they want to have a say in the decision making. And then exit is also planned in advance. So because an investor gets you money, and usually they would have raised money from other LPs or other sources, So they have a mandate in terms of giving back return to them. So they need an exit within. So usually the fund lives of VCs are like 7 to 10 years. So they would have these exit clauses uh, in the agreement beforehand, so that they can exit when their fund life ends. And then there would be the secondary sale rights, like investor cannot sell to your competitors and they cannot sell it in the market. So they will have to offer it to the investor first, and if the investor is not willing to buy, then they can. So all those permutations and combinations of various possibilities will be considered. Similarly, drag along if the founder wants to sell their stake to someone. So, and if that is a good good opportunity, but you cannot you cannot leave the investor. So the investor would ask for a drag along right. So if you are selling your equity, you need to also ensure that the buyer would buy the investor's share. So there are different kinds of uh, rights that can be put in place. There will be like founder employment agreement has to be in place, and then I told about drag along rights and anti-dilution protection, because since as Manu has asked some time back, if still the investor is not convinced on the valuation now, and just trusting, taking that leap of faith and trusting the entrepreneur, they might want to have an anti-dilution protection, so that if you are unable to achieve the milestone and raising the money in the next round at a lower valuation, this investors share shouldn't come down. So so whatever investment they put in now has to be considered at the lower valuation, and they need to be given more shares. So they will ensure that they have the right protection to their capital, and you will have to ensure that you don't lose too much. And once that agreement, once you come into that agreement, is when you have a shareholder agreement, which is executed and then implemented. Any queries?
Sir, if the time permits, I have a query regarding to exit. May I
Yeah,
ask?
yeah. Go ahead.
So, there is a time when the founders or the promoters put in their efforts to realize their team, take the startup to a particular peak. After that, the efforts are not put in by the founders. They have already hit their peak. They tend to move out of the startup. They want to exit.
Mhm.
What is the right time to exit for them, and is it the right decision to exit? So, what is the
Again, these are all individual case by case factors. See, ideally, if an entrepreneur is coming out and starting their own company and trying to build it, so they are actually putting in their life there. They're risking their career. They are leaving their high-paying jobs and coming here to try something. So if they are risking so much, they would want to continue till eternity. But later on during the life cycle, they might lose interest, or it might not be going in the direction that they envision, and then or they might think that they are not the, because not everyone has every skill. So you are an entrepreneur, so you might be able to look at everything uh, at the top of it, and have some idea on every aspect, but you might not be able to go in depth into it. Then in fact that's how companies have transitioned into having an external management. You hire a new CEO from outside the founding team, and you would just take the board seat. So it depends on the course of action, and then you have different investors joining in, different people, and the strategy changes day to day. So all those factors will decide whether you want to continue or want to go out and pursue something. So if you are of the feeling that you've achieved what you can, then you can always hire a CEO or a new person who can lead the company, and you can take the board seat or be in the board to ensure that the company is not going in the wrong direction, and leave the execution to a new management.
Okay,
And
thank you,
when
sir.
it comes to founder or entrepreneur exit, there will be some clauses to ensure that because in the initial stages when someone is investing, they invest based on the team. So if someone from the team is leaving, then it could be a problem for the investor. So that's why they'll ensure that you have the founders also sign an employment agreement for some time and stay with the company to drive it. Later on, if the founder wants to exit, he can always discuss with the investors, and the investors, the board can decide on how they want to go ahead and decide on it. So because no one is catching hold of because if the entrepreneur is not interested, that is not in the right interest of the company. So even the investors doesn't want to lose value. So as long as there is rationality in the decision, no one is going to stop.
Okay, thank you, sir.
So these are some of the key instruments that are used to raise funding. Convertible debt. It is the debentures or loan. So someone would give you loan, but this is convertible. So someone will give you money. There is an interest associated with it, and the value of that loan keeps on increasing based on the interest. And at a point of time, they have a trigger defined. So next round of funding or something, this debt gets converted into equity at that value. So you take 100 rupees today, if the interest is 8%. So after a year, if there is a trigger event when when the investor who has given you money wants that to be converted to equity, then after a year, 100 plus this 8 rupees, 108 rupees worth of equity, they will take, and you don't have to pay back the money. This debt will be converted into equity. And safe note. Safe note, the full form of safe is simple agreement for future equity. So safe note is something similar to convertible debt, but it is classified as equity, where usually previously when I told you, when equity investment is coming in, you decide on the valuation and the dilution and all. But in a safe note, you don't discuss on the pricing now. So you need 25 lakhs, I'll give you 25 lakhs. But when you raise equity in the next round, say if you are raising equity at a valuation of 1 crore next time, convert this 25 lakhs at a valuation of 80 lakhs. So they would want a discount on the valuation for your next round of funding. And they don't decide the valuation now. So now it's just the money in, and no discussion on the valuation, no paperwork. So it is simple, no agreement required, on no terms to be discussed, nothing. You get money within. So they want to invest, they'll trust you, they'll put in money now, and when you raise next round of funding is when this money gets converted into equity based on the valuation then. But this is how this so convertible debt also gets converted into equity. But how this is different is, in a safe note, you don't have the obligation to repay at maturity. So there is no maturity or timeline decided. So that money, whatever money is being put in, will get converted to equity. That's it. So you don't have to pay back that money in a particular time. There is no interest, but convertible debt has it. And the most common instrument when VCs invest, because VCs usually invest in equity, is preference shares. So So usually in a company there is a hierarchy. Initially, so this would happen when a company is being liquidated. So the first preference will be given to debt. So if a company is being liquidated, or that means if a company is being shut down, whatever assets or money is with the company, first that money has to be used to clear the debt, and next would be your preference shares. So these preference shares have hierarchy again. So the recent investor will have the highest preference, and the previous investor. So if a company has raised a Series C, and then they are closing. So after clearing debt, Series C investor would get the first preference, and Series B, Series A, and finally would be the equity holders. So equity is something that the entrepreneurs hold. So preference shares are used majorly for that liquidation preference. So that in the shareholder agreement, all these factors are decided. So when you liquidate, you need to at least give me whatever I've invested. And beyond that, if you still have money that you can give, then so much minimum, so much has to be given. So there will be a liquidation preference at every round. Is that a query? Yeah.
Sir, I just wanted to ask you about the safe note. What is the legal? Is it legally? If any problem occurs, can that be legally sought out, or how is the protection for the
So
investor?
safe note is kind of a mix between preference shares and convertible debt. So when it comes to preference shares, you actually have different clauses that you put in SHA to ensure that legality aspect. So safe note is like a preference share in terms of legality, but when it comes to the valuation and all, safe note doesn't have a valuation decided now. So it will be decided at a later stage. So in that way, it can you put all this into the agreement, and it has legality.
Okay, sir. Thank you.
Any other queries? Okay.
Sir, my query is,
Yeah.
how does the prospects of getting funding vary according to the form of the organization?
Form of the organization. See, most of the VCs or any external investment prefer it has to be a private limited company, because private limited company you can give shares, but when it is a LLP or something else, there is this partnership model, so that doesn't work out for the legality or the process of this board seat and all. So in fact, when an investor is coming on board, so initially even if you are LLP, you can still raise fund, but before the money comes into your account, they would ask you to convert into a private limited company. So what is your current stage doesn't really affect the prospects of raising money, but if you are not flexible to change your form, then it would affect. Okay.
Okay, sir.
So this is a depiction of some of the government schemes that are available at different stages of funding. So you can look at them at leisure, but so in fact you can see this EIR, Prayas, and all are by DST, and then you have DSIR, which is under the Science and Technology Ministry, but a different department. TFAC is again under MIT. TDB soft loans under again IT department, and you have BIRAC programs which are under the biotechnology department in the center. So I'll quickly cover some of the schemes that different government departments have. So some of the schemes so these are the schemes related to only fundraising by the startups. So some of them are which are under Startup India. You have Fund of Funds. So this was devised in, I think, 2014 or 16. I don't remember the exact year, but it is managed by SIDBI, and a corpus of 10,000 crores has been committed until 2025, and I think about 4,000 crores have been committed so far to different startups. So this is the money is given out through VCs. So the VCs, SIDBI would evaluate VCs on their investment thesis and their track record, and SIDBI will go in as a limited partner in the VC fund, and VC would further, as per their process, they would invest in startups. So that is the Fund of Funds. So the fund SIDBI has will invest in different funds, VC funds, and those VC funds would invest in the startups. And then they have a credit guarantee scheme. So usually when banks give credit, they don't do it without a collateral. So under credit guarantee scheme, government would give that guarantee to the bank in lieu of for the startup, and the bank can consider that as the collateral and give up to 2 crore loans to the startup. And then they recently initiated this Startup India Seed Fund scheme. This is again through incubators, which are at least 3-year-old, and they have different criteria to select the incubators which can run this scheme. So under this scheme, incubators can have to run like a VC fund. So incubators have to set up an investment committee, expert committee, how they will evaluate startups. So they'll have to have a process in terms of how they will evaluate a startup, what is the criteria, and follow the process which any VC fund usually follows in selecting the startups and dispersing the money. So the money comes from Startup India and is invested in the startup. So under this scheme, about 20 lakhs can be given as grant or 50 lakhs as an investment, and the incubators would get the management fee. So you might know the VC's business model, right? VC's managed fund. So they are like a mutual fund taking money from LPs. LPs are limited partners, and invest in like mutual funds invest in equity and other instruments, equity as in stock market and other instruments. VCs invest in only non-listed companies or startups, or private companies, and they get management fee for the based on the asset that they're managing. So here in the Startup India Seed Fund scheme too, the incubators would have to work in a similar way and take the management fee. So under the Science and Technology Department, they have this programs under NIDI, National Initiative for Developing and Harnessing Innovations. So under this, they have these 3 schemes. NIDI Prayas, it is given for idea stage company with physical product requirement. So if you are to make a prototype or a machinery, something, if you are a company in automobile space, if you are to make a prototype, you need to make a physical product. So this money is given to such startups. So they would give up to 10 lakhs to make a prototype and give you time until 18 months to actually make the prototype. So this 10 lakhs is not given at a single shot. So you will have to, in those 18 months, give a plan, and stage by stage, you need to give your utilization certificate and take the money. And then Entrepreneur in Residence program. This is a stipend given for an entrepreneur to pursue their business ideas. Since people leave their jobs and they don't have income while pursuing a startup. So this program has been put in place where the entrepreneur is paid stipend every month, so that would cover his day-to-day expenses. They can focus on their idea. So this is a grant usually of the size 10,000 to 30,000 per month, and it is given for 12 months. And then under Nidhi, there is a seed support program. So it is similar to the it is given through the TBIs. So Department of Science and Technology gives grants for to set up incubators. They are called technology business incubators. So through these TBIs, they invest in the startups incubated in these TBIs, and the money being diversed varies from 25 lakhs to a crore. Under MITI is the Ministry of Electronics and IT under the central government. So they have TIDE 2.0 scheme. So under TIDE, they have two things. One is the Entrepreneur in Residence model, where the money is given to develop and validate your idea to have a POC, and about 4 lakhs is given to develop the idea. And then once you have an idea, you would be given a grant of up to 7 lakhs. And this can be utilized to create that MVP from that idea. And under DSIR, you have this PRISM scheme. PRISM is promoting innovation in individual startups and MSMEs. So this is specific to these sectors of green technology, clean energy, industrial utilization, utilizable smart materials. So majorly related to the waste management and such areas. So here for a POC stage, you will be able to get about 2 lakhs or 90% of the cost of your project. So if it is less than 2 lakhs, so whatever is the worth of the project, 10% you need to raise and 90% has to be by can be taken as a grant. And then up to 20 lakhs can be given to fabricate a working model. So again, same thing, 20 lakhs or 90% of the cost that is required for fabrication. And then there is this incubation and R&D. Here for R&D and incubation support, you would get 50 lakhs or 50% of the total cost. So under Department of Biotechnology, these are some of the schemes. So there is the Sustainable Entrepreneurship and Enterprise Development Fund, called SEED Fund in short. It is given through the incubators. So DBT has a BioNest scheme. It is similar to the TBIs under DST. So through these incubators, they give these grants, and they would give up to 30 lakhs for a POC to build a POC. And then they have this Accelerating Entrepreneurs Fund. This is similar to the SIDBI's Fund of Funds model. So they invest through VCs. So here too, they put in money in the VC funds, which would invest in biotechnology companies. And the VCs would further be able to invest up to 7 crores in each startup. And then launching entrepreneurial driven affordable products fund. It is LEAP fund. Again, it is through the BioNest incubators. Here the amount is more than the seed fund. So you would get up to 1 crore. But this is once you cross the POC stage. So seed fund is for the POC stage, and LEAP is for POC to pilot stage. And then they have a BIRAC Ignition grant. This is majorly for the research projects with the commercialization possibility. And here you can get up to 50 lakhs as grant. So that's it. So any queries, feel free to ask. I think we have about 20 minutes time. So you can ask any query. Yeah, go ahead.
Sir, my query is related to the CSR funds being used for the startups. So, what is the culture which is going on in India in this context?
So there is to leverage CSR funds, like say, there is this area of startups called social entrepreneurship. So some startups who are actually working on, they still make profits. It isn't like a non-profit organization, but they would work on the problems of um, financial inclusion or related to child education and all those places. Then CSR funds say you can raise CSR funds and be able to help educating some girl children or educating in government schools. So in that way, you are a social startup, so working towards the social cause. Still, you can raise CSR funds so that ideally for your business model, instead of someone paying for you, there is this donation coming in lieu of the payment from the actual customer. Yeah.
Sir, I have a follow-up query. In the previous days of in the previous sessions, we have discussed a startup is something unique. It is providing a unique solution to a unique problem. When we say about the startups, social startups helping for financial inclusion or uplifting the educational status, how uh, how are those startup unique in that particular aspect, and how the CSR funds are allocated towards them?
See, uniqueness is not just about the problem that they are solving. Uniqueness can be, when you look at the types of innovations, it can be an innovation in execution, or it can be process innovation, or it can be a product innovation, or different kinds of different places where you can innovate. So, if someone is working on a financial inclusion, the way it is implemented might vary. So, but the ultimate problem that they are solving is related to financial inclusion or some social cause. So, since it is related to a social cause, there is a possibility to raise CSR funds. But again, there is a lot of documentation and all the other aspects involved there. So, again, when it comes to CSR funds, the mandate is for I think those companies which are making revenues beyond a threshold. So it always depends on like only big companies would be able to do that CSR, because others, when it comes to as a donation, there are other uh, aspects that you need to look at.
Okay, thank you, sir.
And I think in one of the recent budgets, it has been also informed that CSR funds can be utilized to set up incubators in education institutions. Yeah, any other queries? Yes, go ahead.
Sir, good afternoon, sir.
Yeah.
Actually, prior to registering as either MSME or LLP with any idea, you can go for funding.
Come again.
Prior to registration as a MSME or any LLP, a sound idea can apply for any funding straight away.
See, that's what both are not related, but ultimately, once you want the fund to come into your account, obviously the investor wants you to set up a separate entity, because ultimately he has to take a share. Where do they take? So you can always have the discussions and the agreement process done beforehand, even before you set up a company. But ultimately, for the process to go through and get that money, you will have to set up a company. So you can always raise money, but as I told you, it is not a good idea to raise money when in ideation phase, because we've been seeing many people who have an idea and just wait for funding, but that's not the right thing, because if the idea is worth it, you would be able to convince your family or your friends to put in some money, or someone through your network to put in money, because they know you or they know you through some network, so that they would be able to connect with you. Because someone outside, if they need to trust you, they don't know anything about you, so obviously they wouldn't be able to invest in an idea phase.
So in such cases, is MSME is enough to have the transactions?
When MSME isn't a separate registration as such.
Yeah, that's right.
So as an entity, you will be either a private limited company or an LLP, and you might have a MSME registration which can be used for tax benefits and all. So MSME registration is not an entity.
Yeah, with that, is it possible, or one can suggest to have that kind of agreement between any venture capitalist?
So
If somebody is ready to.
if you need money, the agreement has to be between two entities, right? So VC has to sign agreement with an entity, and what is that entity? It has to be usually when VCs put in money, it has to be a private limited company. So as a private limited company, you can have an MSME registration. You need to have MSME registration to get that tax benefits.
Only to have the tax benefit. Thank you, sir.
Any other queries?
Manu sir, you can go ahead and ask the question if you have any.
Sir, my next query is like it is related to the funding is a one-time thing. We know that. For the incubators, how they can be self-sustainable?
So incubator being self-sustainable, again, there is yes. Incubators are being asked as to register a Section 8 company, which means they need to work like a non-profit. So it has to be self-sustainable, not looking at profit motive. So when it comes to self-sustainability, you need to have again, some of the aspects could be that you can take some equity in lieu of money from the startup. So once the startup pays funding, you have that share, and you can exit immediately, or you might have to charge for the services that you offer on a cost basis. You shouldn't be charging them too high, because startups wouldn't be able to pay. So if you are planning on a large scale, you might look at owning some kind of an equity in the startup, and once the startup succeeds, you would make money. So you are also putting in your skin in the game, that along with the startups that you are incubating. So you need to have a proper selection process so that you get the right startups and you would be investing in the right startups. So that can be your ultimate mode, so that you can be self-sustainable and in fact maybe make more money to further expand your incubation center.
Sir, there is a follow-up query. There could be a lead time in which the incubator has invested in a startup. There will be a lead time when the source of revenue is generated for the startup, and in return, the source of revenue is generated for the incubator. So,
Yes.
in that lead period time, what the incubator should do to sustain itself? Should it rely more on the funding received by the through the government?
That's what in that phase you are also similar to the startup. So how can a startup survive? So you are also like a startup there. So it has to be through the grants that you are getting through the government, or there has to be a sponsor, your sponsor institute or whoever it is, they will have to put in that money. So that's the reason I think in most of the schemes that the government has, they ask you for 3-year projections on how you are going to sustain, and they are funding you for those 3 years, so that you have money for 3 years, and beyond 3 years you are supposed to manage on your own.
Okay, sir. Thank you, sir.
Okay. Yeah, Dr. Ravichandran, I think you can go ahead.
Hello, sir. Good evening.
Good evening. Yes.
Sir, I call you from Coimbatore, sir, in Tamil Nadu. Sir, can tell what is the minimum eligibility criteria to establish incubation cell in engineering college and other colleges? Can the minimum eligibility criteria?
See, there is nothing like a minimum eligibility criteria. If you have even a single student who wants to be an entrepreneur, and if you are willing to support them,
okay,
you can have it. And you need to leverage your university contacts, leveraging the alumni network, alumni database, or through your professors network to help that in a student startup, so that if it grows automatically, there will be more such startups coming in, and your incubation center will grow.
Sorry, actually, I'm asking about the fund from the government. Actually, in our college itself, we have our own incubation center. We are providing seed fund for startup and for a project, and everything is there. If it is innovative product, we will support. Okay, we will support. You have the separate incubation center, our own incubation center. Actually, I am asking how to start, how to establish the incubation center through government. Suppose.
So through government, when it comes to government, there is this incubator support scheme under the Science and Technology, so NSTDB. So they have NSTDB and TBS that they give. So they have their criteria in terms of how much land you need to earmark for it. They have a grant in aid in terms of they would put in some money and you will have to put in some money. And if you are a private institute or education institute, you can always partner with a industry in your region. Coimbatore has these industries, like you have Ampere Electronics and all. So you can also partner with them, and
our college has collaborative MOU with the Ampere Electronics. We regularly recruit the people from our college.
Yes. So you can partner with them so that they can invest. So then you can build a program around EV space. So that will help that particular sponsor who is coming as a corporate. And then you can give a proposal to DST on how you are going to run your incubation center, and how much the sponsor is putting in money, and what are the resources the education institution is giving. And the department would be willing to give up to 5 crores.
Okay, it will be collaborative means good.
Yeah.
Collaborative
education.
Okay.
They have given that, and education institutions, I think you need not bring a corporate also. You can always give some resources from your university space, and money you will get from the department, and you can give resources on maybe from your faculty and all. You can showcase what are the resources that you can give to the startups and how you can incubate.
Okay.
So you might have to go through the websites for the detailed criteria. So, and again you have this Atal Innovation Mission under Niti Aayog.
Okay.
So both have similar criteria, so you can try any of those. So either TBI or AIM. So those are the only thing. And then under biotechnology, you have BioNest, again specific for biotechnology space. So like say under DST, it has to be a technology business incubator, so it has to be limited to technology. And under DBT, it is for biotechnology. Under Niti Aayog, it can be for anything.
In our college, you have UAV system, sir. You have collaborated with Anna University. You have a UAV system, unmanned aerial vehicle system. You have a separate lab. Suppose to we want to establish a UAV system for irrigation and agriculture and other purpose. It will be getting any fund from the.
So you will have to build a proposal around, how you can incubate startups in that area.
Okay.
So you have this expertise. How you can leverage that in startup, in building startup ecosystem, you will have to give a proposal. So the proposal itself, the eligibility criteria and the proposal itself will go up till 70 to 100 pages. So you will have to give a detailed proposal how this is going to, how you are building the ecosystem there. Because as an incubator, in fact, it is always good to choose a few areas where you specialize, where you have resources. Say you have Ampere Electronics MOU, so you can help with electric vehicle space. And then you have UAV system. So you can choose these two areas and build a proposal around these areas. So as an incubator, it is always good to choose areas instead of trying to help everyone.
Okay, sir. Okay, sir. Thank you for your. Thank you, sir. Thank you. Thank you.
So, Chandana, I think if there are no more questions, over to you.
Thank you, sir. Thank you for the valuable session. After this session, we got to know why and when and how we need to raise funding. So thank you for introducing us to the various schemes which our government is providing and other associations are providing in various sectors.
So it's a pleasure joining you all today, and I hope it has been helpful. Thank you so much.
Thank you, sir, for patiently answering all the questions of the participants as well. Thank you very much for joining us, sir.
It's a pleasure. Thank you so much.
Hi, everyone. The feedback form has been posted. Please fill it. And please do use the mail ID which you have registered in AICTE so that you will be properly marked with the attendance. Thank you very much.
Can you send the feedback through mail also?
Okay, sir.
Okay.
Sure, sir.
Okay. Thank you. Thank you.
Thank you, everyone. This is the end of the session of day 2. Let's meet again with fresh information to learn fresh information tomorrow at 9:30. Thank you, sir.
Thank you. Thank you. Thank you, sir.